Welcome to vTalkInsight, Market Drivers Daily for July 16th, 2026. Energy choke points, an uneasy AI boom, and a surprisingly strong growth pulse are colliding today, forcing a rethink of inflation, rates, and equity risk. Let us start with the geopolitical tension that is keeping a structural risk premium in oil and gas. Geopolitical risk around the Strait of Hormuz and the wider Middle East has shifted from episodic headlines toward a more structural constraint on energy supply. Flows are lower, the price floor for oil and gas is higher, and that dynamic is now feeding into inflation expectations, central bank thinking, and sector performance. Over the past few days, we have been tracking how this risk premium has become embedded rather than transient, and today's news flow reinforces that trend. Escalating tension between the United States and Iran has pushed the Strait of Hormuz into a sustained disruption regime. Oil transit volumes through the choke point have fallen sharply, with the 7-day average dropping from around 4.6 million to 3.9 million barrels per day after strikes, blockades, and attacks on shipping. Officials broadly expect disruption to last weeks rather than months. Yet the International Energy Agency has warned that a prolonged closure would carry renewed macro risk and is urging a resolution within that shorter window. At the same time, India is restricting crew deployment in the area, and Gulf states are trying to reroute exports, although geography makes that far harder for countries like Qatar, Kuwait, and Bahrain, keeping logistical stress high. These physical bottlenecks are translating into prices. Brent crude is holding above $85 per barrel, and recent forecasts still assume crude trades above $80 with 85 as a central scenario, while European natural gas prices have doubled since the end of last year with storage well below the 10-year average. Global food prices are up about 10% over the past month, reflecting higher input costs and disrupted shipping routes, adding another supply-side layer to the inflation story. Even with softer consumer and producer price data, markets remain focused on this second wave of inflation from energy and logistics, which is limiting the case for near-term Federal Reserve rate cuts and keeping bond yields elevated, particularly in sensitive markets such as UK gilts. The sector impact is uneven. Major airlines like United and Delta are highlighting record demand and strong pricing power, with corporate travel cited up around 30% and fourth-quarter yields already booked roughly 14% higher than the prior quarter, allowing them to raise outlooks despite record high jet fuel costs. Real airfares remain about 13% below pre-pandemic levels after inflation, suggesting further room for fare increases if oil stays high, although airlines are unable to hedge fuel costs and remain exposed if prices spike again. At the household level, rising gasoline prices and higher utility bills are hitting lower-income consumers hardest, with the personal savings rate down toward 3%, leaving less buffer if energy and food inflation persist. Yet, despite this backdrop, broader equity markets and even oil prices show a relatively muted reaction, suggesting either greater resilience or a degree of complacency. One reason is that the current equity leadership, especially AI-related sectors, is relatively insulated from direct energy cost swings, allowing risk assets to look through geopolitical shocks for now. There are also genuine moderating forces. Both Washington and Tehran are calibrating military operations to avoid maximum escalation or prolonged ground engagement, and additional non-OPEC supply, along with rerouting efforts, is expected to prevent extreme price spikes. However, tail risks remain significant, from potential United States military escalation in Iran or the Red Sea, to new legislation targeting buyers of Russian crude, or even tariffs up to 100% on key importers, any of which could quickly reprice crude and global risk sentiment. Against that backdrop, key watch points are shipping data through Hormuz, policy moves such as Jones Act waivers and sanctions packages, and how Brent trades in the $80 to $90 band, all of which will shape the inflation and rates debate as we turn to the AI complex. Artificial intelligence is still the central growth and earnings engine in global markets, but the narrative has clearly shifted from pure optimism toward a tougher conversation about returns, financing, and regulation. As we highlighted in recent days, the focus is moving from headline model progress to whether the enormous capital expenditure and power needs can generate sustainable cash flows without destabilizing credit and inflation. Today's developments across semiconductors, debt markets, and regulation continue that evolution. On the fundamental side, the numbers remain striking. TSMC has reported robust earnings, beating revenue guidance, lifting its annual United States dollar growth outlook to more than 40% and pushing gross margins close to 68%, all driven by demand for AI-related chips, even as smartphone revenues decline. Management has raised full-year capital expenditure guidance to between $60 and $64 billion, nearly 20% above prior estimates, and is signaling sustained strong hyperscaler demand through at least 2026, including an additional $100 billion of planned investment in United States facilities. These moves are feeding a powerful capex cycle that is supporting suppliers like ASML, industrial names such as ABB, and even private infrastructure assets tied to power and data centers. But markets are no longer pricing this as a one-way upside story. AI-related stocks are under pressure, with the Nasdaq recently dropping around 1.25% and the Philadelphia Semiconductor Index down close to 5%, while TSMC's depository receipts fell despite the strong guidance. Authorities are watching equity leverage behind AI valuations, and credit markets are starting to flash amber, with AI-linked debt spreads widening as investors question whether the unprecedented pace of infrastructure spending, in some cases approaching 90% of operating cash flow, can be serviced if monetization lags. Some observers now describe the AI capex boom as a bubble that will only unwind once companies are forced to cut spending, implying heightened volatility until that inflection point. Policy and technology risks add another layer. Frontier models like Anthropic's Mythos have shown unexpected capability in identifying cyber vulnerabilities, prompting authorities to restrict public release and impose new export controls, which may weigh on valuations but also underline the strategic importance of leading suppliers. Financial regulators increasingly see AI-driven cyber threats to payment systems as a top systemic risk, pushing firms toward rapid patching and constant upgrades, while states across the political spectrum are moving quickly on AI-related regulation that touches data centers, jobs, and energy use. At the same time, AI data center power demand is straining electricity grids, raising consumer power prices in regions such as Northern Virginia, Ohio, and Pennsylvania, and fueling local political backlash and moratoriums that could slow some projects even as overall demand for compute remains insatiable. Inside firms, implementation is proving more gradual and disciplined than the hype might suggest. Banks like Bank of America are insisting on clear business cases and measurable benefits before greenlighting AI projects, after spending billions over a decade to build the data foundations required, and many corporates report that efficiency gains are being redeployed into capacity rather than headcount cuts. Adoption appears strongest in coding and software development, while productivity improvements across broader workflows are emerging more slowly, raising near-term questions about return on capital. Even so, AI-driven compute demand is expected to rise exponentially as generative and so-called agentic systems scale, and the consensus in these insights is that data center and infrastructure demand is likely to remain robust over the long term, with some arguing that the current bull market is more likely to end on a macro shock, such as an energy or credit event, than on an AI bust. For now, the key things to watch are upcoming earnings from hyperscalers like Microsoft, Amazon, and Alphabet, the behavior of AI-related credit spreads, and any new regulatory or cyber developments, all of which feed directly into the growth picture we turn to next. Against this backdrop of energy tension and AI volatility, the macro data and earnings tone point to a surprisingly strong and broad-based expansion. What stands out is how many different parts of the real economy are contributing, from consumers and banks to travel, aerospace, and industrials, rather than a narrow tech-driven rebound. This is consistent with the shift we noted earlier in the week, where earnings strength has been broadening beyond semiconductors into financials and services. In the United States, retail sales are growing, with June's control group up around 0.5%, and management commentary across banks points to resilient spending supported by low unemployment and steady jobless claims. U.S. banks report improved profitability driven by positive operating leverage, accelerating loan growth, and robust credit quality, helped by a more favorable rate environment and somewhat relaxed regulatory intensity. Mortgage production is up about 30% this quarter despite elevated rates, while commercial and middle market loan growth is running at high single digits year over year, suggesting businesses are borrowing to fund real activity rather than just refinancing. Investment banking pipelines, including initial public offerings and capital raises, are described as strong as chief executives look to capitalize on growth opportunities. On the earnings side, the picture is equally robust. The United States market is on track for a 15th consecutive quarter of double-digit earnings growth, an unusually long streak for a mid-cycle phase, with forecasts for overall earnings expansion in the 23 to 26% range. Financials, small banks, insurers, and asset managers are cited as being in the early stages of multi-year growth cycles, while private market and listed infrastructure assets are delivering strong earnings as they help address power and compute bottlenecks tied to AI and electrification. Travel and aerospace are also strong. United Airlines reports no sign of demand destruction. Premium international travel remains robust, and GE Aerospace has raised its outlook multiple times on the back of engine and spare parts demand. In Europe, companies like Sodexo are targeting steady mid-single-digit annual growth. TSMC's expansion supports global supply chains, and the UK has delivered a small upside surprise on monthly GDP, lifting sentiment toward UK assets and the pound. The counterpoint is that this is not a cost-free expansion. Persistent inflation is now expected to run into 2028, with a second wave driven by energy and slow-moving supply chain effects. And management commentary links some of the strength in spending to wealth effects and AI-related gains that may not be permanent. U.S. consumers are increasingly drawing down savings, with the savings rate around 3%, which leaves less room to absorb further increases in oil, food, or power prices. Lower-income households look particularly vulnerable to renewed gasoline and food price spikes tied to Middle East tensions, while small businesses still cite supply chain adjustments and labor availability as key constraints even as they continue to expand. Looking ahead, the durability of this growth phase may hinge on whether credit and policy remain supportive. For now, loan growth is healthy, default rates remain low, and AI-driven capital expenditure is creating a virtuous cycle for banks, capital markets businesses, and infrastructure providers. The main risks flagged in these views are a shock to credit availability or a forced tightening in Federal Reserve policy if inflation, especially from energy, rises enough to challenge its credibility. That kind of macro shock could disrupt AI investment plans and bring this unusually broad earnings cycle to an earlier close. Key indicators to monitor are consumer spending and labor data, loan performance and credit spreads, energy and airfare trends, and the breadth of earnings growth beyond AI and energy as the reporting season progresses. To wrap up, persistent strain at key energy choke points is hardening a structural oil and gas risk premium, raising the floor under inflation and complicating the path for interest rates and rate-sensitive assets. AI remains a powerful driver of earnings and capital expenditure, but markets are now repricing leverage, regulation, and return on investment, leading to sharper dispersion across both equity and credit. At the same time, the growth backdrop is unusually strong for a mid-cycle phase, with consumers, banks, travel, and infrastructure all contributing, even as energy costs and low savings rates build medium-term vulnerabilities. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.